The line just got crossed. In 2026, one of the biggest banks on earth is preparing to hold Bitcoin the same way it holds bonds, stocks, and cash. Not in a "we're thinking about it" way, not in a pilot program way, in a "we're building the custody rails and turning it on" way. And at the exact same time, a trillion-dollar wealth machine is pushing crypto trading closer to the everyday investor than it's ever been, while quietly exploring the thing that changes everything: Bitcoin lending. This isn't a hype cycle. This is plumbing. This is the moment the old system stops pointing at crypto from a distance and starts wiring crypto into its own backbone. And once the wiring is in the walls, it doesn't come back out. Here's what happened, clearly, right now. Major Wall Street institutions are moving from crypto exposure to crypto infrastructure. Custody, trading, wallet rails, collateral, yield, 24/7 settlement logic. The stuff that turns Bitcoin from that thing over there into an asset the system can actually use. That's the real story. Because when a bank can custody your Bitcoin, report it, collateralize it, lend against it, and settle it alongside treasuries, Bitcoin doesn't just sit in the corner of your portfolio anymore. It becomes part of the machine. I'm your host and welcome. No noise, no fluff, just the moves that matter, what they mean, and what they unlock next. And by the end of this, you'll understand why 2026 isn't another year in crypto. It's the year the doors inside the bank quietly opened. Let's start with the custody move, because custody is not a buzzword. Custody is power. In traditional finance, the most important question is never what asset is popular. It's who holds it. If you own stocks through a broker, you don't keep the certificates under your mattress. The system keeps them. The system tracks them. The system reports them. The system makes them usable. That's custody. And for decades, Bitcoin sat outside that world, by design. You held it yourself, or you used a crypto-native platform. And for institutions, that created friction so thick it acted like a wall. Key management, wallet security, operational procedures, compliance policies, audit trails, insurance, recovery, human error risk. One wrong click and you can lose a fortune. Institutions hate that. Not because they hate innovation, because they hate uncertainty. Now picture what changes when a major global bank says, "We'll hold it for you. We'll integrate it. We'll make it behave like the other assets you already use." That's not a product announcement. That's a category change. Here's the core vision that's being built. One account experience across crypto, securities, and cash-like instruments, with a single operating model that looks and feels like what institutions already know. Same rails, same controls, same reporting expectations. And that's the magic trick. Because the moment Bitcoin can be handled inside the same operational framework as treasuries and equities, the institutional barrier stops being philosophical. It becomes procedural. And procedures can be scaled. Now let me translate what that single model idea means in real life. Right now, big money is forced to split itself across systems. A fund has its prime broker for traditional assets. It has separate accounts for custody. It has separate workflows for digital assets, separate teams, separate tools, separate risk systems, separate reconciliation headaches. That fragmentation is expensive, and it kills adoption even when demand exists. So the real promise is not Bitcoin in the bank app. The real promise is that Bitcoin becomes a native line item in the same portfolio engine that already runs the world's wealth. And that's why this matters. Because once Bitcoin lives inside that engine, it can do something it couldn't easily do before. It can become collateral. This is the part most people miss, and it's the part that turns a custody announcement into a system-wide domino. In finance, collateral is not just protection. Collateral is leverage. Collateral is flexibility. Collateral is efficiency. If you can pledge one asset to support activity in another lane, your capital becomes more productive. You can do more without moving as much cash. You can reduce idle balances. You can optimize margin. You can operate faster. That's the concept of cross-margining. And when Bitcoin is inside the custody umbrella of a major institution, the conversation shifts from, "Can we hold it?" to, "What can we do with it?" That's the jump from ownership to utility. That's the jump from store of value to financial instrument that plugs into the machine. Now imagine a portfolio where treasuries sit alongside Bitcoin. Imagine the system recognizing both. Imagine risk models, haircuts, collateral terms, loan-to-value ratios, margin requirements. You don't have to love the idea to understand the consequence. If Bitcoin becomes acceptable collateral inside mainstream finance, demand is no longer only about speculation. Demand becomes about functionality. And functionality doesn't turn off when sentiment turns. That is how an asset goes from trendy to structural. Now, there's another layer here that matters even more than collateral, because it forces the entire banking world to upgrade itself. Bitcoin is a 24/7 asset. Traditional markets are not. Banks are built on schedules. Market opens, market closes, settlement windows, batch processing, end-of-day reporting, weekend freezes, holiday slowdowns. Bitcoin doesn't care. Bitcoin trades at 2 a.m. on Sunday. It trades during holidays. It trades while the serious markets are sleeping. So if a bank wants to provide real, institutional-grade custody and services around Bitcoin, it can't just add a crypto tab. It has to change how time works inside its own systems. This is the quiet revolution. Because a 24/7 asset forces 24/7 money movement expectations. If Bitcoin is moving, clients will demand the ability to respond in real time. And that means the system needs money that can move on that same clock, or at least a proxy that behaves like it. So what happens? Banks start building always-on digital cash rails, tokenized internal settlement layers, faster transaction finality, real-time reconciliation, automated compliance checks that don't wait for Monday. Not because it's trendy, because the asset forces it. This is how crypto doesn't just get adopted, it drags the rest of finance into a new operating system. And once that shift begins, it doesn't stop with Bitcoin. Because if you can operate 24/7 for one asset, the pressure to expand that to other assets becomes obvious. Why should your Bitcoin trade non-stop, but your stocks freeze at 4 p.m.? Why should tokenized assets settle instantly, but your traditional settlement waits in a queue? Why should your portfolio be live only half the day? That's the question that begins to haunt every exchange, every broker, every clearinghouse. And here's where the story gets bigger, because this isn't happening in isolation. At the same time these custody and banking rails are being prepared, the trading venues themselves are inching toward a world where markets don't sleep. And when the biggest exchanges start flirting with around-the-clock trading, you're no longer watching crypto becoming legitimate. You're watching traditional finance become more like crypto. That's the real convergence. Now hold that thought because we need to talk about the second major move, wealth distribution. Custody is about institutions and infrastructure. Distribution is about scale. And the wealth platform move is about taking crypto from specialized to default available. The biggest friction in crypto adoption has never been interest. It's been trust and complexity. People don't want seed phrases. People don't want to worry about hacks. People don't want to learn wallet types. People don't want to feel stupid making a mistake. They want it to work like the rest of their finances. And the moment crypto becomes something you can access inside a platform you already use for stocks and retirement, the friction collapses. Not for hardcore crypto natives, for the giant middle, the people who are curious, cautious, and wealthy enough to matter. Now look at the specific playbook being built. First, regulated wrappers. When traditional wealth clients want exposure, they often want it in a familiar shape. Exchange-traded products, funds, structured vehicles, things that fit into the existing compliance and advisory framework. That's not sexy, but it's powerful, because familiarity is a ramp. Second, spot access through mainstream trading platforms. This is the distribution moment. When spot crypto trading shows up on a platform that already has millions of users, crypto doesn't need to recruit new participants from scratch. It just needs a button. That's why this matters. Because once you can buy crypto where you already buy stocks, crypto stops being a separate world. It becomes another asset class inside the same behavior. That changes who participates. It changes how often they participate, and it changes how durable the flows can become. Third, wallet integration inside the wealth management stack. This is the part that sounds boring until you realize what it means. If a wealth manager can see your crypto alongside your equities, bonds, cash, and other allocations, crypto becomes part of the conversation. Not an external secret. Not an awkward, I also have a Coinbase account. A line item. A managed exposure. And that's where a huge amount of money lives, in managed behavior. Fourth, lending and yield. This is the high-voltage wire. Because when the system starts offering yield on digital assets through traditional institutions, the story isn't only hold Bitcoin. The story becomes use Bitcoin. And when you can lend, borrow, and generate yield, you've entered the world where Bitcoin behaves less like a collectible and more like collateral-grade capital. Now I need you to see why this is such a big step. Lending changes everything because it creates a second market around the asset, the market for liquidity. If you can lend Bitcoin, you can price its cost of capital. If you can borrow against it, you can create strategies around it. If you can integrate it into portfolio planning, it becomes more sticky. And sticky is what institutions worship. But lending also introduces a nightmare: risk, counterparty risk, liquidity risk, volatility risk, regulatory risk, operational risk. That's why the biggest institutions don't casually do it. If they are exploring it, the signal is not, they want a marketing headline. The signal is, the client demand is big enough, and the pathway is clear enough, that it's worth building the internal machinery. And that brings us to the most revealing part of this entire wave: the decision to build, not rent. In the early era, everyone partnered. It was faster, it was cheaper, it was good enough. But renting crypto infrastructure has a ceiling, because you don't control the stack, you don't control the risk, you don't control the experience. And if crypto is becoming a core business line, renting becomes a liability. So when a major wealth institution says the quiet part out loud, "We want this built inside our own systems," they're telling you they're not testing the water. They're buying the pool. This is the difference between a crypto feature and a crypto strategy. And strategies don't get reversed because the chart had a bad month. Now zoom out. Put both moves on the table at the same time. Custody rails being built by a major bank. Distribution and trading rails being built by a major wealth platform. And in the background, the exchanges themselves leaning toward a longer trading day, even a 24/7 direction. This is not a series of random announcements. This is a synchronization. It's the financial system collectively rotating its posture from observe to integrate. And that triggers a question that most people are not asking yet, but they should. If Bitcoin becomes bank custodied, wealth managed, collateralized, and lendable, what happens to the identity of Bitcoin? Some people will say this is the victory lap. The system is admitting Bitcoin is permanent. Others will say this is the trap. Bitcoin is supposed to be self-held, censorship-resistant, outside the control grid. If your Bitcoin sits inside a bank custody framework, then in a crisis, can it be frozen? Can it be restricted? Can access become conditional? That tension is real, and it's not going away. But here's the key point. The existence of institutional custody does not delete self-custody. You can still hold your own keys. You can still opt out. Institutional rails are not a replacement, they're an expansion. They expand the range of participants. And when the participant pool expands, the market structure changes. Liquidity deepens, access broadens, and demand becomes more layered. Some will buy for sovereignty, others will buy for portfolio allocation. Others will buy because their advisor offers it in a standard model. Others will buy because their institution can now hold it under familiar rules. Different motivations, same asset, bigger market. And now we arrive at the part that turns this into a retention story, not a news recap. Because infrastructure always creates second-order effects. And second-order effects are where the real shifts happen. Here are the big consequences that follow once the rails go live. 1. Operational friction collapses for institutions. That sounds technical, but it's massive. Most institutions don't avoid Bitcoin because they think it's not real. They avoid it because the operational overhead makes it not worth the headache. Custody changes that. 2. Bitcoin becomes more financialized. Collateral, lending, structured products, cross-asset strategies, risk models. That creates demand that is less emotional and more functional. 3. 24/7 expectations spread. Once clients get used to always-on assets, they start demanding always-on access across more of their portfolio. This is how crypto doesn't just get adopted, it reforms the schedule of finance. 4. Competition intensifies. When multiple giants are building rails, they're not building them for fun. They're building them to own the client relationship in the next era. And whoever owns that relationship owns the flow. 5. The narrative war gets louder. Because when mainstream institutions integrate crypto, the conversation splits. One side screams, "This proves legitimacy." The other side screams, "This proves capture." And in the middle are millions of people who don't care about ideology. They care about usability, safety, and returns. That middle is where adoption actually happens. Now let's address the question sitting in the back of everyone's mind. What about regulation? This is where people love to panic. But think about incentives. The biggest banks and wealth firms on earth do not sprint into a legal fog for entertainment. They don't do it because a crypto influencer told them it's the future. They do it when the rules are clear enough, or the path is controlled enough, that the risk is manageable. That doesn't mean regulation can't evolve. It means the direction has stabilized enough for the heavyweights to move. And once the heavyweights move, regulators tend to formalize frameworks around what's already happening, because the system likes order. Now I want to ask you two questions because I want you to think like a strategist, not like a spectator. First question. If your Bitcoin is held inside a major bank's custody, does that make you feel safer, or does it make you feel more exposed? Second question. If your wealth platform offers easy crypto access and yield opportunities, do you think that brings smarter money in, or does it bring riskier behavior in faster? Drop your take in the comments because the answer to those two questions reveals what kind of crypto era we're walking into next. And now let's talk about the psychological trap hiding inside this mainstream integration story. The trap is that people assume institutional adoption means instant price explosion. Sometimes it does. Sometimes it doesn't. Because infrastructure is a slow burn until it suddenly isn't. Rails get built quietly. Legal frameworks get drafted quietly. Back-end systems get tested quietly. Client onboarding gets planned quietly. Then one day, it turns on. And the flows that were theoretical become routine. That's how structural shifts happen. Not with fireworks, with switches. So the real question is not, will Bitcoin go up tomorrow? The real question is, what happens when Bitcoin becomes a default option inside mainstream portfolios, and the operational barriers that kept big allocators away are reduced? Because once that starts, the conversation shifts from, should we own Bitcoin, to what percent should we own? And when the question becomes percentage allocation, the market stops being only about narrative. It becomes about math. But there's a darker angle too, and you have to be honest about it. When Bitcoin is held by institutions, it's easier for institutions to use it, but it can also be easier for institutions to restrict it. Not because they want to be evil, because they operate inside policy, inside compliance, inside legal mandates. So a future where Bitcoin is bank integrated is a future with more access, and potentially more control points. That's the trade-off. More adoption, more convenience, more participation, less pure sovereignty for those who choose the custodial route. And that's why self-custody remains a personal decision, not a moral badge. Now, we need to connect the final dot. Why is 24/7 the hidden story behind all of this? Because if you can trade tokenized assets around the clock, if you can settle money instantly, if you can hold crypto alongside securities in one operating model, the line between crypto markets and traditional markets starts to dissolve. And when that line dissolves, something insane becomes possible. A world where your portfolio is always live. A world where market hours feel archaic. A world where assets move with the speed of software. That sounds futuristic, but pieces of it are being built right now, under your feet, by the exact institutions people assumed would resist it forever. And the institutions that build these rails first gain a strategic advantage that is very hard to catch. Because when you build the rails, you control the flow. Now let's land this with the practical takeaway because I don't want you walking away with vibes. I want you walking away with clarity. Here's what you should remember. Custody is not a headline. Custody is infrastructure. Infrastructure changes who can participate. Who can participate changes market structure. Market structure changes what's possible. And 2026 is looking like the year major players stopped treating crypto like an experiment and started treating it like a permanent lane. If you're watching this space, you don't need to believe every hype narrative. You just need to watch the plumbing. Because the plumbing tells the truth before the price chart does. Now here's the cliffhanger you should keep in your mind. If banks can custody Bitcoin, and wealth platforms can trade it, and lending frameworks start to mature, the next question isn't, will institutions adopt Bitcoin? They already are. The next question is, what happens when institutions start competing with each other to offer the most aggressive crypto services? Who offers the best yield? Who offers the cleanest collateral terms? Who integrates it into retirement accounts first? Who becomes the default crypto bank for the mainstream? That competition is where the acceleration happens. And that's the part most people will only notice after it's already underway. If you want to stay ahead of that curve, don't just watch price. Watch policy. Watch product launches. Watch custody rails. Watch who is building and who is hesitating. Because hesitation is expensive in a land grab. Before you go, I want one more thing from you. Which matters more to you, convenience or control? Do you want Bitcoin to be as easy as a savings account, even if it's custodial? Or do you want maximum sovereignty, even if it takes more responsibility? Tell me in the comments. I read them, and your answers shape what we break down next. And if you want more clear, fast, no-fluff analysis like this, subscribe. Short and simple, subscribe now, because the next wave won't wait for anyone.